So one of the benefits, I guess, of being where you are in your chair is you get to see like what these mortgage banks are doing. You can see if they're suffering from losses. You can see if they're, this quarter from that quarter to that, and the next quarter, you get to see kind of where they're at financially, and then you meet with them, right? And you get to ask them like what they're doing. Kind of you find out what what's causing the good or the bad. Necessarily.
Yeah, absolutely. Yeah.
So tell us like what's the general pulse or temperature of the industry right now?
Yeah, so we're just finished up closing out all of 2018, right?
Oh,
so
yeah.
so 2018 financials were due March 31st, which was just Sunday.
Okay.
And so last year, I would say overall, most companies had a very difficult year. Production was down.
Yeah.
But in turn, what we've seen in addition to that is the first quarter things are up. So although we're upset about last year, they're very optimistic about what's going on in 2019. Where we look and we track new loan apps and see how that's building, and most pipelines have been building over this quarter. And so people are optimistic right now. I don't think there's more optimism, I would say, going into 2019 than there was in 2018. And
interesting.
It's been a big difference.
What do you think is causing that change in optimism?
I think the non-QM space certainly is giving people some additional hope for growth, better margins. In 2018, the secondary market wasn't the appetite for the asset class wasn't very good,
right? And
so that decline in that appetite drove the overall price down for mortgage banks.
Yeah, I kept hearing margin compression.
Yeah, it was very difficult. Some of that is coming back a little bit, but I think still in your traditional space, there's still a fallout of some of that margin that wasn't here like in 2016, for example, which was a great year, right? 16 into 17, yeah.
Like companies like Impact and I think Cash Call, like I heard they're publicly traded, so you can see their financials, but they had pretty big losses, and I know that. After.
So that overall, that whole asset class was off 30 basis points at least. So overall, just because there's other assets in the secondary market that people were more attracted to, and it's pretty simple economics, right? So there's not enough room on these loans that they can make enough money.
The broker a point or two or whatever it is, and they got to make their branch margin, and they got to make their
right. And the cost per acquisition is not going down. The cost to manufacture a loan has not been going down. So some stats you look at the average price to per loan is almost, it was inverse in the average amount made per loan on a gross basis. Jeez. So, even people that had an increase in production, if they weren't paying attention to margins, were losing money. So even more, the more they originated, even more they lost. So that was a very difficult year for a lot of clients, and not all. Some clients were really, they paid attention to that, really controlled their cost structure, and had a good year. But I'd say the vast majority had taken some substantial dips in their overall net worth due to losses.